Greetings, esteemed students. I hope I find you well and ready for another enriching week in our journey through the Acca FA1 syllabus. I am Mr. J. Mutimukulu, your ACCA tutor in OBU/ACCA BSc registered mentor. Let's delve into the intricacies of our focus for week 5. Topic: Receiving, checking and recording money. Objective: Our primary objective this week is to master the art of efficiently receiving, meticulously checking, and accurately recording financial transactions. In the realm of financial accounting, precision and attention to detail are paramount. By the end of this week, you should be adept in these fundamental skills. Contact information: should you have any queries or require further clarification throughout the week, please feel free to reach out to me. You can contact me via cell +263 774 596 368. Email jmutimukulu@gmail.com. Key concepts for week 5. 1. Receipts handling. Understanding the proper procedures for receiving monetary transactions. Implementing robust controls to safeguard against errors or discrepancies. Differentiating between various forms of payments, such as cash, checks, and electronic transfers. 2. Verification and checking. Rigorous checking processes to ensure the accuracy of received funds. Cross-referencing against supporting documentation. Identifying and rectifying discrepancies promptly. 3. Record keeping. Accurate and systematic recording of financial transactions. Utilizing appropriate accounting software or manual ledgers. Maintaining a clear audit trail for future reference. Now, before we proceed any further, let's begin with a brief recap of the double-entry bookkeeping system and the essential books of accounts. Double-entry bookkeeping system. The double-entry bookkeeping system is a fundamental accounting method that ensures every financial transaction has equal and opposite effects on at least two accounts. This system follows the accounting equation: assets equals liabilities plus equity. Remember, equity is another word for capital. In double-entry bookkeeping, each transaction involves a debit entry and a corresponding credit entry. Debits and credits must always balance. Here's a quick overview. 1. Debit, DR. Increases assets and expenses. Decreases liabilities and income. 2. Credit, CR. Increases liabilities and income. Decreases assets and expenses. Books of accounts. In the double-entry system, transactions are recorded from various books of accounts, each serving a specific purpose. Here are the books of prime or original entry. 1. Cash book. Records all cash transactions, both inflows, receipts, and outflows, payments. Includes details like date, description, and amount. 2. Sales day book. Records all credit sales transactions. Provides details of the goods or services sold on credit. 3. Purchase day book. Records all credit purchase transactions. Details the goods or services acquired on credit. 4. Sales returns book. Documents goods returned by customers. Reflects credit notes issued. 5. Purchase returns book. Records goods returned to suppliers. Captures debit notes issued. 6. Journal. Captures non-routine transactions not covered by other books. Entries include adjustments, accruals, and depreciation. 7. Petty cash book. Manages small, routine cash expenses. Simplifies the reconciliation of petty cash transactions. Recap action points. Every transaction involves a debit and a credit. Debits and credits must balance. Assets equals liabilities plus equity, accounting equation. Book of prime entry are 7, namely, the cash book, sales and purchase day books, sales and purchase returns day books, journal, and petty cash book. However, entry of a transaction to a book of prime entry does not record the double entry required for that transaction. These books are only sources of the transaction's double entry to the ledger accounts. The double entry arising from the book of prime entry will be recorded periodically, daily, weekly, monthly, depending on the volume of the transactions. Understanding the double entry system and the books of prime entry is foundational to maintaining accurate and transparent financial records. As we delve deeper into the intricacies of financial accounting, these principles will be instrumental in your journey toward financial proficiency. The following summary succinctly captures key components of the double entry system, the role of various ledgers, and the significance of books of prime entry. Thus, 1. General ledger, also known as nominal ledger. The central repository for all accounts in the double entry system. Accounts are categorized into assets, liabilities, equity, revenue, and expenses. Summarizes transactions and account balances. 2. Cash book. Records all cash transactions, including both receipts and payments. Essential for tracking the cash position of a business. Assists in reconciling bank statements. 3. Petty cash book. Manages small, routine cash expenses that don't warrant individual entries in the main cash book. Facilitates control and tracking of minor expenditures. Simplifies the reconciliation process. 4. Receivables and payables ledgers. Receivables ledger details individual amounts owed to the business by customers. An amount to summarize this information, the receivables control account, is normally contained within the general ledger. Payables ledger provides a breakdown of amounts the business owes to suppliers. An amount to summarize this information, the payables control account, is normally contained within the general ledger. These ledgers offer a more granular view of transactions beyond what the nominal ledger provides. However, they are not part of the general ledger or double entry bookkeeping system. This is why they are called memorandum accounts. Controls over receipts. Effective control over receipts is vital for ensuring the accuracy, security, and transparency of financial transactions. Let's delve into key controls, including banking, security, and documentation. 1. Banking controls. Prompt and correct banking of cash or check receipts. This reduces risk of theft, misappropriation, or loss of cash or check receipts. Improves accountability of receipts. Daily banking reconciliation. Regular reconciliation of daily banking transactions against internal records. Ensures that all receipts are accurately deposited in the bank. Identifies discrepancies promptly. Segregation of duties. Different individuals or teams should handle the receipt process in banking. Minimizes the risk of collusion and enhances accountability. Cross-verification between teams adds an extra layer of control. Dual authorization. Require dual authorization for significant banking transactions. 2 authorized individuals must approve before funds are moved or withdrawn. Mitigates the risk of unauthorized transactions. 2. Security controls. Access control. Restrict access to areas where receipts are handled. Use electronic systems to limit access based on roles and responsibilities. Prevents unauthorized individuals from tampering with or misappropriating funds. Physical security. Safeguard physical receipt documents in secure areas. Implement security measures such as locks, surveillance, and access cards. Reduces the risk of theft or unauthorized access. Electronic security. Employ encryption and secure login credentials for electronic systems. Regularly update and monitor security measures to protect against cyber threats. Ensures the confidentiality and integrity of electronic receipt data. 3. Documentation controls. Remittance advice. Provide detailed remittance advice for each receipt received. Include information such as invoice numbers, payment details, and customer information. Facilitates accurate allocation of receipts to the corresponding invoices. Reconciliation with bank statements. Reconcile remittance advice with bank statements to verify the accuracy of received funds. Quickly identify any discrepancies between expected and actual receipts. Enhances the overall accuracy of financial records. Audit trail. Maintain a clear audit trail for each receipt transaction. Document the entire lifecycle of a receipt, from initiation to deposit. Simplifies internal and external audits, ensuring transparency. By implementing these controls, organizations can establish a robust framework for managing and safeguarding their receipts. These measures not only mitigate risks related to fraud or errors but also contribute to the overall integrity and reliability of financial reporting. Example: control over cash receipts. Suppose your company sells $10,000 worth of items to XYZ in April. You receive a $10,000 check with a remittance advice indicating which invoices it covers. F. Check the validity and accuracy of the check before depositing it into the corporate account within 24 hours per business policy, banked promptly. B. A colleague notes the check details and checks it to the remittance advice, checking for completeness. To ensure completeness, payments are typically compared to the entire amount owing by the consumer. C. Separating roles between the person who banks and one who records is an effective way to prevent theft and accidental loss. Checks are now pre-printed crossed and can only be paid to the payee's account. This helps to safeguard against loss and theft. Procedures to compare receipt with remittance advice. Comparing receipts with remittance advice is a crucial process to ensure accuracy in financial transactions. Here are procedures to effectively carry out this comparison. 1. Receipt identification. Unique reference numbers. Assign unique reference numbers to each receipt. This could be a transaction number, invoice number, or another identifier. Clear documentation. Clearly document the date and details of each receipt to facilitate easy identification during the comparison process. 2. Remittance advice review. Detailed remittance advice. Ensure that the remittance advice accompanying the payment is comprehensive, including details like the payer's name, payment date, and a breakdown of amounts allocated to specific invoices. Match invoice details. Verify that the information on the remittance advice corresponds accurately to the details of the invoices or transactions being settled. 3. Matching amounts. Cross-check amounts. Compare the total amount stated on the remittance advice with the actual amount received. Allocation verification. Confirm that the amounts allocated to specific invoices or accounts on the remittance advice match the corresponding amounts on the receipt. 4. Date verification. Payment date comparison. Verify that the payment date mentioned on the remittance advice aligns with the date the funds were received. Timely reconciliation. Ensure that the reconciliation is performed promptly to identify and address discrepancies in a timely manner. 5. Allocation confirmation. Allocation accuracy. Confirm that the amounts allocated on the remittance advice match the intended allocation to specific invoices or accounts. Proper coding. Check that the remittance advice includes correct coding for various transactions, aiding in accurate allocation. 6. Communication with payers. Clarification. Establish a communication channel with payers to address any discrepancies or seek clarification on unclear remittance advice. Prompt response. Encourage payers to promptly respond to queries, facilitating quick resolution of discrepancies. 7. Automated matching systems. Utilize technology. Employ automated systems or accounting software that can facilitate the matching process. Reduce manual errors. Automated systems can significantly reduce the risk of manual errors in the comparison of receipts and remittance advice. 8. Reconciliation documentation. Maintain records. Keep detailed records of the reconciliation process, including the steps taken, any discrepancies found, and the resolutions implemented. Audit trail. Establish an audit trail to track changes and ensure transparency. By rigorously following these procedures, organizations can enhance the accuracy and reliability of their financial records, reduce the risk of errors, and promptly address any discrepancies between receipts and remittance advice. This meticulous approach contributes to the overall financial integrity of the organization. Receipts given to customers. Till receipts or written receipts should contain certain information. A receipt is a document given by the seller to the buyer when goods change hands in exchange for payment. It may be a till receipt, a written receipt, or some other form of receipt. Cash registers or tills are used mainly in retail shops where the money is handed over directly by the customer when the transaction takes place, in the form of cash, checks, and card vouchers. The cash register can act as part of the control over calculating and giving change to customers. There are a number of potential errors in giving change, each of which will affect the customer directly and the business indirectly, e.g. giving too little change to the customer may annoy customers and lead to loss of goodwill, and giving too much may lead to loss of money by the business. Each till receipt will show some or all of the following. A. The name of the selling company or business. B. The date, and possibly the time, of the transaction. C. The price of each of the goods purchased. D. The total value of goods purchased. E. The sales tax registration number, if applicable, of the selling company or business. F. The amount tendered, given, by the customer. G. The amount of change given to the customer. H. The name of the assistant and/or cashier. 1. The till number. Written receipts, where a cash register is not used, then a written or typed receipt may be required. The same information should appear as that which appears on the till receipt, although it is often easier to enter more detailed information about the goods sold on a written receipt. Evidence of payment other than in cash. Evidence of payment, aside from cash transactions, is crucial for financial record keeping and documentation. Here are common forms of evidence for non-cash payments. 1. Bank statements. Electronic or paper statements. Bank statements provide a comprehensive record of all transactions, including deposits, withdrawals, and electronic transfers. Transaction details. Each transaction on the statement includes relevant details such as date, amount, and the parties involved. 2. Checks. Cancelled checks. A cancelled check, with the payee's endorsement and bank stamp, serves as evidence of payment. Check images. In electronic banking, check images provided by the bank can be used as evidence. 3. Wire transfer confirmation. Confirmation documents. For wire transfers, banks issue confirmation documents detailing the transaction particulars. SWIFT messages. Society for Worldwide Interbank Financial Telecommunication, SWIFT, messages are often used for international wire transfers, providing a secure and standardized format for communication between banks. 4. Credit card statements. Monthly statements. Credit card statements outline all transactions made using the credit card. Transaction details. Similar to bank statements, credit card statements include transaction dates, amounts, and vendor information. 5. Electronic fund transfer, EFT, records. Payment advice. Organizations may provide payment advice documents for EFT transactions, outlining the payment details. Confirmation emails. Online banking systems often send confirmation emails for EFT transactions. 6. Direct debit authorization. Authorization forms. Direct debit authorization forms signed by the payer serve as evidence of permission for automatic withdrawals. Bank records. The bank provides records of direct debit transactions and statements. 7. Payment receipts. Electronic or paper receipts, issued by the payee. Receipts confirm the receipt of payment. Acknowledgement emails. In electronic transactions, acknowledgement emails can serve as digital receipts. 8. Mobile payment apps. Transaction histories. Mobile payment apps maintain a transaction history, providing details of payments made. Confirmation notifications. Users often receive instant notifications confirming successful transactions. 9. Promissory notes or loan agreements. Legal documentation. For loans or large transactions, promissory notes or loan agreements serve as evidence of the agreement and repayment terms. Amortization schedules. In the case of loans, amortization schedules outline repayment schedules and amounts. 10. Stock or bond certificates. Ownership documents. In the case of securities, physical certificates or electronic statements serve as evidence of ownership. Dividend statements. Dividend statements indicate payments to stockholders. 11. Trade credit agreements. Credit terms. Agreements outlining credit terms between trading partners serve as evidence of payment expectations. Invoices. Invoices issued by suppliers and payment confirmations indicate credit transactions. Ensuring proper documentation and retention of these forms of evidence is essential for financial accountability, audit compliance, and dispute resolution. The choice of evidence depends on the nature of the transaction and the preferred method of payment. Various ways in which customers pay. There are various ways a company can receive money. The main ones are cash, check, and credit or debit card, or simply plastic cards. Unlike in the previous slides where we refer a receipt as a document given to the purchaser by the seller, here, a receipt refers to the act of the seller accepting payment and to the payment itself once it has been accepted. Generally, the way a company receives money will depend on the type of business it is in. Other forms of receipt include the following. 1. Standing order. 2. Direct debit. 3. Mail transfer and telegraphic transfer. 4. Automated credit services. Cash, physical security considerations. Ensuring the physical security of cash is crucial for protecting assets, preventing theft, and maintaining the integrity of financial operations. Here are key considerations for maintaining the physical security of cash. 1. Frequent banking. Definition: frequent banking refers to the practice of depositing cash into a bank account regularly, reducing the amount of cash stored on site. Security benefits. Risk mitigation minimizes the risk of loss due to theft or unexpected events. Reduced exposure limits the amount of cash accessible on the premises. Enhanced record-keeping facilitates accurate financial record-keeping through regular reconciliations with bank statements. Implementation tips. Establish banking schedule. Develop a regular schedule for cash deposits based on business needs. Use secure transportation. When transporting cash to the bank, utilize secure means, such as armored vehicles or reputable cash-in-transit services. Vary deposit times. Vary the times of day for banking transactions to avoid predictability. 2. Protective glass. Definition: protective glass, also known as bullet-resistant or bulletproof glass, is a security feature designed to protect against forced entry or attacks. Security benefits. Deterrence: acts as a visible deterrent, discouraging potential criminals from attempting a robbery. Physical barrier: provides a physical barrier between employees and potential threats. Safety: enhances the safety of employees and customers during a security incident. Implementation tips. Install quality glass. Use certified and tested protective glass that meets security standards. Strategic placement. Ensure that protective glass is strategically placed at vulnerable points, such as cashier counters. Regular maintenance. Conduct regular maintenance to ensure the glass remains effective over time. 3. Cash register security. Definition: cash register security involves measures to safeguard the cash register system and its contents from theft or unauthorized access. Security benefits. Financial integrity: protects the integrity of financial transactions and prevents fraudulent activities. Employee accountability: encourages responsible handling of cash by employees. Transaction tracking: enables accurate tracking of sales and cash transactions. Implementation tips. User authentication. Implement user authentication features, such as unique login credentials for each employee using the cash register. Transaction logging. Maintain a detailed log of transactions, including timestamps and user information. Surveillance cameras. Install surveillance cameras to monitor cash register areas and deter internal theft. Regular audits. Conduct periodic audits of cash register transactions to identify discrepancies or irregularities. 4. Safe storage. Secure safes. Invest in high-quality safes with robust locking mechanisms. Bolted safes. Ensure safes are securely bolted to the floor or a wall to prevent unauthorized removal. Multiple compartments. Safes with multiple compartments allow for organized storage and segregation of different denominations. 5. Restricted access. Authorized personnel only. Limit access to cash storage areas to authorized personnel only. Access controls. Implement electronic access controls, PIN codes, or biometric authentication for added security. Surveillance cameras. Install surveillance cameras to monitor access points and deter potential theft. 6. Cash handling procedures. Designated handlers assign specific individuals responsible for cash handling. Rotation of duties implement a rotation of duties to prevent collusion among employees. Documentation maintain detailed records of cash transactions, including receipts, withdrawals, and deposits. 7. Secured transportation. Armored vehicles, when transporting large sums of cash, use reputable armored transport services. Discrete routes vary transportation routes and schedules to reduce predictability. Security personnel employ security personnel for escort and protection during cash transport. 8. Security personnel. Trained guards employ trained security personnel to monitor cash storage areas. Visible presence ensure security personnel have a visible presence to deter potential thieves. Emergency protocols establish protocols for responding to security breaches or suspicious activities. 9. Cash limits at points of sale. Limited cash on hand implement policies that limit the amount of cash kept at points of sale. Frequent deposits encourage regular deposits to banks to minimize the cash on hand. 10. Alarm systems. Intrusion alarms install intrusion alarms with sensors on doors and windows. Silent alarms consider silent alarms that alert security personnel or law enforcement discreetly. Monitoring ensure that alarm systems are monitored 24/7 for immediate response to security breaches. By incorporating these physical security considerations, businesses can significantly reduce the risk of cash-related incidents, deter potential theft, and create a secure environment for financial operations. Regularly reassessing security measures and staying vigilant against emerging threats is also essential in maintaining a robust cash security system. Checks. A check is an unconditional order in writing addressed by a person to a bank, signed by the person giving it, requiring the bank to pay on demand a sum certain in money to or to the order of a specified person or bearer. Checks and card vouchers are less easily exchanged by a thief, but the same security procedures should be maintained for checks and card vouchers as for cash. A check may be sent through the post, as if it goes astray payment can be stopped. Checks are gradually being replaced by card transactions. Receipt of check payments. It is best practice to follow these procedures when an individual customer pays by check. Step 1. Examine the face of the check to ensure all the details are correct. Date, including the year. Payee name. Amount in both words and figures. Step 2. Make sure that the check is signed by the drawer. The terms payee and drawer are commonly used in the context of financial transactions, particularly in the issuance and negotiation of checks. Here's the difference between the payee and the drawer. 1. Payee. Definition: the payee is the individual or entity to whom a payment is directed or to whom a check is made payable. In other words, the payee is the party who receives the funds. Role: the payee is the intended recipient of the payment, and the check is issued to them for a specific amount. Example: in a typical scenario, if Wang Du writes a check for $500 to Maria for services rendered, Maria is the payee. The check would be made payable to Maria or the name of Maria's business. 2. Drawer. Definition: the drawer is the person or entity who writes and signs a check, initiating the payment. The drawer is essentially the person who draws the check on their bank account. Role: the drawer authorizes the transfer of funds from their bank account to the payee by issuing the check. Example: if Chiedza writes a check to her landlord to pay the monthly rent, Chiedza is the drawer. She writes and signs the check, instructing her bank to transfer the specified amount to her landlord. In summary, the payee is the recipient of the funds, and the drawer is the person who initiates the payment by writing and signing the check. In a check transaction, the drawer's bank is responsible for honoring the check by transferring the specified funds from the drawer's account to the payee. It's worth noting that in some cases, especially in business transactions, the same individual or entity can be both the drawer and the payee. For instance, a company may issue a check to itself for internal fund transfers or to move money between accounts. Receipt of card payments. Strict procedures should also be followed when accepting credit or debit cards as payment. Please refer to the text for detailed security check procedures. Plastic card payments have become progressively more popular as methods of payment over the last few years. They are used primarily by individuals, rather than by companies, although companies do own credit cards which are generally allocated to members of staff for their use to pay business expenses. Most retail outlets which accept credit and charge cards now use an electronic system known in the UK as FPOS, Electronic Funds Transfer at Point of Sale. We will examine FPOS procedures in the coming slides. There are two types of plastic cards, credit card and debit card. But what are they? Credit cards. Credit cards issued by companies like Visa and MasterCard are widely used in business transactions. Here's how these credit cards work in the context of business transactions. 1. Card acceptance. Merchant agreement. Businesses enter into agreements with financial institutions or payment processors to accept credit cards as a form of payment. Point of sale, POS systems. Merchants use POS systems, card readers, or online payment gateways to process credit card transactions. 2. Customer purchase. Customer presents the card. The customer provides their Visa or MasterCard to the merchant when making a purchase. Card verification. The merchant may verify the customer's identity by checking the signature on the card or by requiring a PIN or signature for authorization. 3. Authorization request. Merchant sends authorization request. The merchant's POS system sends an authorization request to the payment processor or acquiring bank. Transaction details. The request includes transaction details such as the card number, transaction amount, and merchant information. 4. Authorization approval. Authorization response. The payment processor checks the customer's available credit, verifies the transaction, and sends an authorization response to the merchant. Approval or decline. The response indicates whether the transaction is approved or declined based on the customer's credit limit and other factors. 5. Transaction completion. Customer completes purchase. If the transaction is approved, the customer completes the purchase, either by signing a receipt or entering a PIN. Confirmation. The merchant provides the customer with a receipt confirming the successful transaction. 6. Payment settlement. End of the day settlement. At the end of the business day, the merchant submits a batch of authorized transactions for settlement. Funds transfer. The acquiring bank transfers the funds from the customer's issuing bank to the merchant's account, completing the settlement process. 7. Interchange fees. Interchange fees. Merchants pay interchange fees to the card networks, Visa, MasterCard, and acquiring banks for processing credit card transactions. Costs and pricing. The fees cover the costs of transaction processing and are a factor in determining the pricing of goods and services. 8. Monthly statements. Merchant statements. Merchants receive monthly statements detailing the transactions, fees, and settlements. Reconciliation. Merchants reconcile their accounts to ensure accuracy and track cash flow related to credit card transactions. 9. Chargebacks and disputes. Customer disputes. Customers may dispute transactions due to issues like fraud or dissatisfaction. Chargeback process. Merchants follow a chargeback process, providing evidence to dispute or accept the chargeback. 10. Security measures. Security standards. Merchants adhere to Payment Card Industry Data Security Standard, PCI DSS, requirements to ensure the secure handling of cardholder data. Tokenization and encryption. Technologies like tokenization and encryption enhance the security of card transactions. 11. Rewards and benefits. Cardholder rewards. Customers using Visa or MasterCard may earn rewards, cash back, or other benefits based on their spending. Promotional programs. Merchants may participate in promotional programs offered by the card networks to attract cardholders. Understanding these processes helps businesses effectively manage credit card transactions, ensuring smooth payment processing, compliance with security standards, and positive interactions with customers using Visa or MasterCard. Accepting a credit card receipt. Credit card transactions can be accepted over the telephone or in person over the counter. There are certain security checks that you must make before you can accept a credit card as payment. Refer to text. The telephone check system does not only exist for when a transaction is over the floor limit. A retailer can ring up if he is suspicious of the validity of the card and use a code to warn the credit card company that he is worried. The credit card company staff can then double-check their records, and they may also ask questions of the retailer and/or the customer to prove the identity of the customer. Debit cards. Debit cards are designed for customers who like paying by plastic card but who do not always want credit. The customer signs a voucher at the point of sale. This is then either processed through the credit card system, for example Barclays Connect card is a Visa card, or through an FPOS system, see below. The amount is deducted directly from the customer's bank account. If the debit card transaction has to be processed manually, then the voucher used is very similar to the vouchers used for credit card transactions. So, what's the difference between a credit and debit card? In short, the primary difference between debit and credit cards lies in how they access funds. Debit card, linked to a bank account. A debit card allows you to spend only the money available in your account. Transactions directly deduct funds from your bank balance. Credit card, issued by a credit card company. A credit card enables you to borrow money up to a set credit limit. You must repay the borrowed amount, usually on a monthly basis, and interest is charged on any outstanding balance. FPOS. FPOS, electronic funds transfer at point of sale, is a means of allowing a transaction to be recorded immediately on customer bank accounts or credit card statements, while at the same time authorizing the transaction. It makes possible the automatic transfer of funds from a customer's bank account to a retail organization at the point in time when the customer purchases goods or services from it. The effect has been to reduce both the number of checks written and the number of debit or credit card transactions processed manually. Most types of credit card and debit card can be processed through the FPOS terminal, which sits on or by the retailer's counter. The terminal can read the magnetic strips on the backs of cards automatically. Why FPOS terminals in shops? The terminal allows businesses to capture card transactions electronically, which has many advantages over the manual system outlined above. They do not physically have to take vouchers to the bank to get paid. When a retailer carries out a transaction on the terminal, it will automatically telephone the appropriate card company and seek authorization, eliminating the need to ring them for approval of transactions above the floor limit. At the same time, the transaction will also be accepted by the card company for processing and subsequent payment to the retailer's account. The terminal generates a two-part receipt for customers to sign, replacing manual vouchers as previously discussed. The receipt includes the card data, the transaction amount, and the supplier details. The customer receives the top copy of this receipt, while the store maintains the bottom section for his records. Many FPOS outlets now provide chip and PIN. This includes the client entering his PIN number rather than signing. Why safeguarding PIN digits significantly minimizes the danger of credit and debit card fraud. In the United Kingdom, card payments now require a chip and PIN. However, there is already proof of fraud using chip and PIN. There is probably no solution that can totally prevent fraud. Other receipts. Banker's draft. This is a payment mechanism provided through banks for a fee. Paying by banker's draft is typical when a customer is purchasing property and need a guarantee that the payment will not be dishonored in order to complete the transaction. Standing orders and direct debits. These forms of payments will be discussed in greater detail in future sections. They are recurring payments, often monthly. Only the payer can adjust the amount of a standing order, whereas the receiver can change the amount of a direct debit at any time. Example, types of payments. Question. Assume you work in several distinct firms, as described below. In each scenario, a customer or potential customer calls you to inquire about how a payment or payments might be made. Task. State what you would say in response to the consumer, including any assumptions about the firm's practices that you believe are suitable. You should explain your reasoning as part of your response. The consumer's inquiries are as follows. A business, electricity firm. I am a residential customer and get a bill from you every quarter. I'd like to continue paying quarterly, but I don't want to go to the hassle of writing a check or making a special journey to a bank or your office to do so. However, I need to know how much the bill will be before I have to pay it. What type of payment would you recommend? Answer. You can pay with a quarterly direct debit. You must submit a direct debit mandate form, which authorizes us to deduct funds from your bank account. We will send you a bill as usual each quarter, and the amount owing will be debited from your account 14 days after the statement date, so you will know how much will be debited ahead of time. If an error is made, either the bank or us must make it right. B. Business, house builder. If I buy one of your houses, I'll be getting a mortgage, and some of the funds will come from my building society. However, some will be required from me once the deal is complete. How will that need to be paid? Answer. Normally, any balance owed to us once the deal is finalized will be paid by banker's draft or automated credit. A banker's draft or automatic credit is deemed as good as cash, and while cash is accepted, paying such a huge sum in cash is unusual and inconvenient. Tutorial note: a builder may accept a check for a deposit on a house, but he is unlikely to accept a check when the sale is finished because he must hand over the keys and the check may be dishonored. C. Business, mail order company. I'd like to place an order with you. I don't have a bank account, a building society account, or a credit card, so I guess I'll have to pay you the money through the mail. Is that okay? Answer. We do not recommend sending cash through the post since we cannot accept responsibility if it is misplaced. We recommend that you pay with a postal order issued from your post office. The post office will charge you a fee for this service. Aspects in money recording. Recording cash transactions accurately is crucial for financial integrity. Here are key controls to ensure proper recording of cash. 1. Separation of duties. Divide responsibilities. Different individuals should handle the various aspects of cash handling, such as receiving, recording, and reconciling, to prevent fraud or errors. 2. Dual authorization. Require 2 approvals. Implement a system where 2 individuals must authorize and verify cash transactions to enhance accountability and reduce the risk of unauthorized transactions. 3. Use of pre-numbered receipts. Sequential numbering. Utilize pre-numbered receipts for all cash transactions. This helps in tracking and ensures that no transactions are omitted or duplicated. 4. Daily reconciliation. Reconcile cash daily. Regularly reconcile the cash on hand with recorded transactions at the end of each business day to promptly identify and address discrepancies. 5. Surprise audits. Random audits. Conduct surprise cash counts or audits periodically to deter theft and ensure that the recorded cash matches the physical amount on hand. 6. Cash registers and point-of-sale (POS) systems. Automation. Use cash registers or POS systems that automatically record transactions. This reduces manual errors and provides a digital trail for auditing. 7. Segregation of cash handling. Separate cash handling roles. Differentiate roles between employees who handle cash and those responsible for recording transactions. This minimizes the risk of collusion. 8. Secure storage. Safe and secure storage. Store cash in a secure location, such as a safe, to prevent theft. Limit access to authorized personnel only. 9. Regular training. Educate employees, train employees on proper cash handling procedures, emphasizing the importance of accuracy, security, and adherence to controls. 10. Documented procedures. Written policies have clear and documented procedures for recording cash transactions. This serves as a reference for employees and helps maintain consistency. 11. Banking procedures. Prompt deposits. Establish a policy for the prompt deposit of cash into the company's bank account to minimize the risk of loss or theft. 12. Monitoring and analysis. Review transactions. Regularly review cash transactions for anomalies or patterns that may indicate irregularities. Analyze discrepancies promptly. 13. Internal and external audits. Regular auditing. Conduct internal audits or hire external auditors to review cash handling procedures and ensure compliance with controls. 14. Electronic payment methods. Encourage electronic payments. Where applicable, encourage customers to use electronic payment methods, reducing the reliance on physical cash and enhancing traceability. Implementing these controls creates a robust framework for recording cash transactions accurately, safeguarding against errors, fraud, and other risks associated with cash handling. Posting cash receipts to the general ledger. Posting cash receipts to the general ledger involves recording the financial transactions related to the receipt of cash in the company's accounting records. Here is a step-by-step process for posting cash receipts to the general ledger. 1. Prepare source documents. Collect source documents, such as cash register tapes, receipts, or remittance advices, that provide details of the cash transactions. 2. Verify accuracy. Confirm that the source documents are accurate and match the actual cash received. Check for any discrepancies or errors. 3. Create journal entries. Generate journal entries for each cash receipt transaction. The journal entry typically includes the date, accounts affected, and the amount of cash received. 4. Debit cash account. Debit the cash account to increase its balance. This reflects the increase in the amount of cash held by the company. 5. Credit relevant revenue or accounts receivable accounts. Credit the appropriate revenue account or accounts receivable account. This depends on the nature of the transaction. If it's a sale, credit the revenue account. If it's a payment on account, credit the accounts receivable account. 6. Allocate discounts or fees. If there are any discounts or fees associated with the cash receipt, allocate them accordingly. For example, if a discount is given for early payment, adjust the accounts accordingly. 7. Post to the general ledger. Transfer the journal entries to the general ledger. The general ledger is a master accounting document that contains all the company's accounts. 8. Reconcile accounts. Regularly reconcile the cash account and the relevant revenue or accounts receivable accounts to ensure that the general ledger balances match the actual cash on hand and the amounts owed by customers. 9. Maintain supporting documentation. Keep the source documents and any additional supporting documentation with the journal entries. This documentation serves as evidence for the recorded transactions and is crucial for audits or reviews. 10. Review and approval. Have a review process in place to ensure that the journal entries are accurate and comply with accounting policies. Obtain necessary approvals before finalizing the postings. 11. Record discounts or bad debts. If applicable, record any discounts allowed or bad debts related to the cash receipts. Adjust the accounts accordingly. 12. Update subsidiary ledgers. If the company maintains subsidiary ledgers for customers, update these ledgers with the relevant information to track individual transactions and customer balances. By following these steps, a company can accurately record and post cash receipts to the general ledger, maintaining the integrity of its financial records and facilitating accurate financial reporting. Regular reconciliation and adherence to accounting principles are essential in ensuring the accuracy of the recorded transactions. Summary. Receipts play a crucial role in maintaining good cash flow, with key control features including prompt and accurate banking, security measures to prevent loss or theft, and proper documentation like remittance advice. Trade customers typically include remittance advice with payments. Till or written receipts should contain essential information. Companies can receive payments through various methods such as cash, checks, or credit/debit cards. Holding cash requires careful security procedures. Strict protocols should be followed when accepting card payments. FPOS facilitates immediate recording on customer bank accounts or credit card statements while authorizing the transaction. In conclusion, I encourage you to approach this week with enthusiasm and a commitment to excellence in mastering the intricacies of receiving, checking, and recording money in financial accounting. Your dedication will undoubtedly pave the way for a solid foundation in this fundamental aspect of accounting. Feel free to connect with me at any time for guidance or clarification. I look forward to a week of fruitful learning together. Best regards. J. Mutimukulu, ACCA tutor in OBU/ACCA BSc registered mentor. Transkyle Business School. +263 774 596 368. Email jmutimukulu@gmail.com.